pretty diversified. It sells into nearly all industries: consumer goods, construction, energy, beauty, personal care, packaging, textiles, automotive, telecommunications. So if one sector's down, the other sector's going to maybe be up and balance things out. I don't know how much they can shift from one sector to another, but I don't think there's a lot of risk for the dividend because it's coming from so many different parts of the economy. Of course, if we do have a recession, the stock will be hit pretty hard. It is a global company and again manufacturing, but I'll show you on the chart that I think it's not too bad of a price right now. And even if the market did correct, these are the kind of stocks, like all the money just can't leave the market. It can't, it's even hard, like where's it going to go? We don't really have a bond market anymore because of the Federal Reserve banks have driven interest rates down so low. So I think the alternative is a lot of pension funds, that type of thing, are going to say, well, let's park our money with Dow. We can get a dividend yield of 5% plus. If things are really bad, maybe that dividend gets cut, but hopefully it doesn't get cut too much. And so there's a chance the price could actually, it could be counter what the market does. So, and the stock has been a little bit volatile, which I think just because kind of being valued with a spin-off from DuPont, the analysts are trying to find fair value for the company. But Value Line gives it an A+ for financial strength. So they're comfortable with all their debt and don't see them being too leveraged. A+ is their highest rating. And Morningstar gives it a 4 to 5 star rating. Fortunately, I didn't have a write-up on it because I enjoy the Morningstar write-up reports. They're usually pretty good, a little bit more detailed than Value Line. And they have a price target 53, 59, and I think we're trading at 44 right now. And let's pull up the chart for that one. So you can see here, it just started trading as Dow with DuPont spun off last year. It's gone, it's been fairly volatile for a big blue chip company, but we've gone from 60 right down to 40, back up to 56, and then I picked it up here around 46, so I'm not really making any money, not really losing any money. I would be quite content if it just traded sideways and I could pick up the dividend. And up in here, I think it may be, if the economy slows down and if we do have a bit of a market correction, then it's probably not likely to get back up into the mid-50s. And so what I did, I'll show the math on this shortly, is I did a 55 covered call for January 21st, and for that I received a premium of $1.75, which you receive right away. The risk is if the stock goes above 55 before the strike date, then the stock's taken away at 55. Even if it's $60 or $65, the maximum I can get is $55 strike price. And I don't see that being too much of a risk. And the premium was, normally you can't get premium on a blue chip company like this because the volatility of the stock is so low. Instead of $1.75, you may only get 70 cents, and it's not really worth doing because you can have the shares taken away so easily. But with the overall market volatility increasing, because of coronavirus and stuff, the VIX, which is a measure of the overall market volatility, spiked up to 20, and we've been sitting down here in 12s for a long time, and we've actually settled back down into 15, but when I probably bought the shares, they're probably about 18. So what that does is kind of, you know, a tide that lifts all boats kind of thing. Once the VIX goes up, that means all options premiums kind of get adjusted upwards. And then with the stock itself, like as I showed in the chart, being a little bit volatile, I was able to get, well, I thought, a pretty good premium for a blue chip company. And I'll show how this plays out in Excel, or maybe not. Yeah, so I did erase all that. I had it all here. But by doing that, one covered call, it basically gives me almost 2.5 more dividend payments in that time, and actually brings the yield up to over 8%. And fortunately, I erased that. But yeah, so I'll give an example, not again on the future, but anyways, it ends up turning that blue chip into almost like a riskier high dividend paying company. And so I might buy more of that, but I'm in no rush. I'll see how the market plays out, maybe in a month's time. If it's where it is now, I'll do something similar, buy some more and then do a covered call on it, if I can still get a reasonable premium. Get back here. So, and one thing I did do, I actually did a short last week, which is a bet that the share price is going to go down. Basically, you borrow shares from the market and hoping to resell them later at, buy them back later at a lower price. So I did a short sell on VRSN, which is VRSN. VRSN is a solo authorized registry for your .com and your .NET. For your internet. So it does have kind of a bit of a monopoly in what it does, and it does have 13 root servers that use to direct internet traffic. So I think just that alone kind of drove the stock up a lot more than what it should have. It's only really growing at 10-12%. Morningstar has a fair value of 154. I figure it's worth about 140, not taking into account what I'm going to say shortly, and it's trading at 206. So, and the big flag here was its retained earnings is negative $17 billion. So if the company went out of business today, it would be worth negative $17 billion. And this goes back to what I was talking about last week about share repurchases just being kind of silly, and I don't understand why analysts aren't calling companies out on this. You're totally, the company has no book value, and it's completely worthless. So all they're betting on is that the future cash flows will eventually rebuild that return earnings, but you could be looking at 20, 30 years for that to happen. So, but before doing a short, I did quickly look at the short ratio and the percent short of the float. Percent short of the float is the number of shares that are shorted to the number of shares that are issued or tradable, and it was 1.15%, which isn't that high. Tesla, for example, and what we've been reading about, and the crazy price swings happening there. One reason that is happening because its percent short is 13%. So 13% if the stock is short. And your losses on a long position, most you can ever lose is 100%. On a short position, there's an infinite amount of money you can lose, because in theory, the stock can keep going up. There's no upper bound, there's a lower bound on the long position. So Tesla, if it reports really good earnings, and with the social media and everything else, the stock can be driven up way beyond what fundamental values would take, and that happens all the time in the market. There's fundamentals, and then there's the whole emotional side of things. And we did see that with Tesla almost going to 1,000. So you can imagine what these people felt like when they maybe started shorting the stock at 400 or 500. And sometimes they may get a margin call and get forced out and have to buy. And then when all these shorts start buying, that causes the stock to go up more, so it's like a positive feedback loop. And so in this case, the short flow is quite low. The short ratio, which is the number of days it would take a normal volume to cover all the shorts, was 2.34, which is not super low, but not too bad either. So, and then the reason I did it, because I don't really know if the market's going to roll over yet. There's no signs of it. I just feel myself could have a difficult time in the next few months. But the reason